One line that stood out for me, of course, the expectation that you're not going to be profitable in the next financial year, and then the expectation that international flights for Qantas won't be starting up, you don't think, until July of 2021. I just wonder, if we get a vaccine in the next few months, does that change your view on the impact of the airline industry and how quickly you can get back up to something resembling full operation?
Well, I think even if we get a vaccine in the next few months, it's going to take some time for it to roll out to be an effective reason why the international borders will close down. I have to say, Qantas is in a lot better position than most airlines around the world, because we have parts of our businesses that are really going well today. Our loyalty business, our freight business, our resource fly-in, fly-out business, and we're optimistic about the domestic business. We're working with the states and the federal government to try and open up the state borders more. And the suppression of COVID-19 here in Australia is a test case around the globe. And we're hopeful that we can have the majority of our domestic business up by the end of the year. They're the big profit drivers for Qantas. Where international won't make money is international will still be very cash positive if we can get all of them up and running. What international has is nearly $800 million in depreciation each year, which is a non-cash cause that we won't be able to cover if we're not flying international. And we think it's a sensible decision to assume that the 380s and the 777s need to be parked for at least a year, so that we can save the costs associated with those aircraft and help reduce the cash burn from our international business.
And Alan, talking of the cash burn, how much longer do you have in terms of runway, ignore the pun, in terms of funding, and when will you potentially need to tap additional funding to keep the business afloat?
Well, we're in a very good position because we've already raised $1.75 billion at very low interest rates with no covenants on the debt market, and recently a $1.4 billion equity raise, which has given us $4.5 billion worth of liquidity at the end of June. The outflows for us at the moment are $40 million a week, but that includes financing and reinvesting costs. A lot of airlines are not counting that in their cash burn. Actually, our operating businesses are covering their cost. It's actually just the working capital movements and the investment of financial cash flows that are making us negative, which are not damaging the balance sheet. So we have plenty of runway to get all the way through 21 under current conditions and into 22. We don't think domestic will last that long. There's a lot of positive domestically. When we've opened up domestic routes, like the intrastate routes, Brisbane to Cairns, we're actually getting more traffic than we were pre-COVID-19. That route is up to 7 or 8 frequencies a day. It's huge volumes. There's huge pent-up demand. So we're optimistic that that cash burn will not last for the full year once the domestic borders are opening up. And we're working with the governments in order for that to occur.
Alan, David here. A pleasure to have you on the program. And I'm glad you mentioned that. I think the last time, the three of us at least, Tom included, and you joined us on the program was back in May. At that point, lots of moving parts, of course. At that point, you told us, worst case scenario, the cash you had back then would have lasted you end of next year. We obviously know things have changed. You're laying off workers. You've raised new cash. The reason I bring those two things up, what makes you say that the conditions that you now expect to persist will indeed be the worst case scenario? And for investors, what degree of confidence can they now attach to that scenario that you had just put out if you had just changed very recently those assumptions that you made?
Yeah, so one of the things we're going to have to all cope with is that this is varying quite a bit, and you have to be flexible. And what we typically do is adjust our plan to cope with the environment that we're seeing. So we did say in June there would be at least 6,000 redundancies, and we are going to announce in the next few weeks and months more changes that are restructuring the business for the future. And what we're aiming for is to take advantage of the opportunities we have coming out of this. We have an unbelievably strong position domestically with the two brands, Qantas and Jetstar, that produced the majority of our profits even before COVID-19. And we're a main competitor in administration, coming out smaller. We think there's further opportunities for us to grow that, and we see huge pent-up demand. We have our loyalty program, which even in this environment is performing exceptionally well. Our freight business that has record profits. So the issue for us will be international, and that will be dependent on a vaccine. But we do think international could open bubble by bubble. So if New Zealand gets their current second wave under control and it's a similar level to Australia, there is no reason why those two borders shouldn't be opened up. And that's the largest international market in and out of Australia and in and out of New Zealand. So there are opportunities there that we're optimistic about, and we're trying to position ourselves to take $1 billion of cost out on an annual basis, so that when we come out of this, when COVID's behind us, we are the strongest airline in the region. We're the strongest airline with the best balance sheet. We're the strongest airline that can take advantage of the growth opportunities, and we think there will be some.
Alan, with everything that you're doing to, I wouldn't say shrink the airline, but rationalize given what you're trying to do in saving your cash burn, do you think there's now a risk in the event that things suddenly open up, and that is, of course, the hope, that you might not be positioned to reopen or turn to switch things back on as quickly to take advantage of things reopening in the event we do get to that point?
No, we're keeping that flexibility there. So we've put the A380s as an example. We don't think we'll need them, given IATA forecasts and our forecast for at least 3 years. But those aircraft can be activated if we need it and the demand is there. So we know that there's huge flexibility to opt up. And we will be standing down our people, some people, up to 15,000 people for more than a year. So we will have people, pilots and cabin crew, that we can activate if demand comes back faster than we've expected. And I think the worldwide industry is such that a lot of airlines are shrinking by 30, 40, 50%. We're reducing our size and employment group by around 20 to 25%. So there will be, I think, in the industry for a period of time, a lot of opportunities to hire people, skilled people, if that's needed. And our domestic competitor here is shrinking quite considerably. So there will be a lot of skill sets here in Australia if that happens to occur. Now, you always, I think, plan for the worst and hope for the best, but give yourself flexibility in scenarios around different requirements, and that's what we're continuing to do.